Look at the screen for a moment and take a breath, because what I'm about to say may sound unbelievable at first. Bitcoin is sitting near $70,000 again. Not at the peak, not at the collapse, but in that strange middle zone where markets feel quiet on the surface and violent underneath. And when I see markets like this, I don't see calm. I see pressure building. You might be hearing analysts on television talking about fear, about downside risks, about targets being cut. You've seen the headlines. Forecasts reduced. Sentiment collapsing. The fear and greed index sitting in extreme fear territory. These are the signals most people focus on. But if you've watched markets long enough, you know something important. The loudest signals are often the least useful ones. What matters are the broken signals, the things that don't behave the way they should. Let me explain what I mean, and I want you to think about this carefully. Bitcoin fell from above $120,000 to near $60,000. In previous cycles, a drop like that would have shattered the structure completely. Liquidity would disappear, volume would collapse, dominance would weaken as capital fled the space. But that didn't fully happen. The market bent, but it did not break. Institutional flows slowed. But you didn't see the mass exits that defined earlier crashes. Bitcoin dominance remained elevated. That tells you something critical about capital behavior. When investors are truly abandoning an asset class, dominance falls and correlation breaks. But here, even as altcoins weakened, capital kept rotating back toward Bitcoin itself. That is not panic behavior. That is defensive accumulation behavior. And I want you to remember something from financial history. In 2009, after the global financial crisis, markets looked broken. In 2012, during the European debt crisis, investors believed the Eurozone might fracture. In March 2020, during the pandemic panic, liquidity vanished across all asset classes in a matter of days. Each time, the moment of maximum pessimism appeared just before a powerful recovery phase began. Markets don't turn when confidence returns. Markets turn when confidence is gone. Now look at the real forces underneath the surface, not the noise on top. Bitcoin's supply schedule has not changed. The halving cycle reduced the issuance rate dramatically. That is not a narrative. That is mathematics. Every day, fewer coins enter circulation than in previous years. Meanwhile, global liquidity conditions, although still uncertain, are no longer tightening at the pace we saw before. Central banks are no longer universally aggressive in their tightening cycles. Bond markets are already pricing future easing in several major economies. And liquidity, whether people like to admit it or not, is the oxygen of all risk assets. When liquidity expands, capital searches for return. When capital searches for return, it moves first into the most liquid and recognizable assets. And in the digital asset space, there is one asset that institutions trust more than any other. You already know which one that is. But here is where the contradiction appears, and I want you to think about this deeply. On one hand, sentiment is extremely bearish. On the other hand, the structural drivers that historically precede large rallies are quietly aligning: reduced supply, stabilizing liquidity expectations, persistent institutional interest, and a market that refuses to collapse despite repeated negative headlines. That contradiction is not a coincidence. Contradictions are where turning points are born. If you were sitting at a trading desk in 2015, you would have seen the same pattern. In 2019, the same pattern again. The majority of investors waited for clarity, waited for confirmation, waited for the headlines to change. And by the time clarity arrived, the market had already moved. I'm not telling you what will happen tomorrow, and I'm not telling you what anyone should buy or sell. That's not the point. The point is understanding the environment, understanding the forces that move markets long before the public notices them. Right now, what I see is a market that has absorbed a massive correction without losing its structural foundation. I see capital that has become cautious, not absent. I see a global macro environment that is shifting, slowly but visibly. And I see sentiment so low that even small positive catalysts could create outsized reactions. And when you combine low expectations with tightening supply and the possibility of improving liquidity, you create the conditions where explosive moves can begin, not gradually, but suddenly. That is why this moment matters. Not because of where the price is today, but because of what the underlying structure is telling us. Markets whisper before they roar. And right now, if you listen carefully, the whispers are getting louder. Now I want you to shift your attention away from the price for a moment and focus on something far more important, something most people completely ignore. Price is only the surface. Structure is what moves markets. And right now, the structure underneath Bitcoin is changing in ways that are easy to miss if you're only watching charts. Let me take you back in time for a moment, because history is the only teacher that never lies. After the 2012 halving, Bitcoin did not explode immediately. It moved slowly, quietly, almost boringly, and then suddenly the acceleration began. The same thing happened after the 2016 halving. And again, after the 2020 halving, each cycle followed a similar rhythm. Supply shock first, disbelief second, and only later the vertical phase. We are now living inside that same window in the cycle, and I need you to understand what that means in real terms. Every single day, fewer new Bitcoins are being created than in previous years. That is not speculation. That is code. That is a structural supply contraction happening in real time, whether the market feels optimistic or pessimistic. And supply shocks don't announce themselves loudly. They build pressure silently, like steam in a sealed chamber. At the same time, demand has changed in a way that many people still underestimate. Years ago, Bitcoin was mostly driven by retail speculation, sudden hype, sudden crashes, waves of emotional money entering and leaving. But today, the landscape is different. Institutional capital does not behave the same way as retail capital. It moves slower, it allocates gradually, and most importantly, it rarely exits completely once exposure has been established. This is something I've seen repeatedly across markets. When pension funds entered equities in the late 20th century, volatility patterns changed. When sovereign funds began allocating to commodities, price cycles lengthened and deepened. And now, with ETFs and institutional vehicles, Bitcoin is undergoing the same structural transition. You are no longer looking at a purely speculative instrument. You are looking at an asset that is gradually integrating into the global capital framework. Now let's talk about liquidity, because this is where the real engine sits. You may hear commentators say that central banks are still restrictive, that interest rates remain high, that financial conditions are tight. All of that is partially true, but markets don't move based on the present alone. Markets move based on expectations of the future. Bond yields begin to shift before policy shifts. Currency markets react before official announcements. Liquidity expectations change months before liquidity itself expands. And right now, across multiple major economies, forward expectations are already starting to move. Rate cuts are being discussed. Balance sheet policies are being reconsidered. Fiscal pressures are mounting globally, and history tells us how governments respond to those pressures. They print, they stimulate, and they inject liquidity. And every time that has happened over the past 15 years, risk assets have responded first and fastest. Think back to 2009. Think back to 2020. Massive liquidity injections did not just lift equities. They lifted everything that had scarcity and narrative power. Gold surged, technology stocks surged, and eventually Bitcoin surged. Liquidity does not discriminate. It flows where opportunity and momentum meet. But here's the critical point that most people are missing right now. The market is still positioned defensively. Sentiment remains weak. Forecasts remain cautious. And yet the structural drivers, reduced supply, persistent institutional demand, and shifting liquidity expectations, are quietly aligning at the same time. This is the phase where markets become dangerous, not because they are falling, but because they are preparing to move faster than people expect. I want you to picture a compressed spring. When pressure builds gradually, nothing seems to happen for a long time. Then, in a very short moment, all that stored energy releases at once. Financial markets behave the same way. Long periods of sideways movement often precede the most violent trends, and this is where global confirmation begins to appear, not in headlines, but in behavior. Bitcoin holding critical levels despite negative news, capital rotating into the strongest assets during corrections. Volatility declining after major drawdowns instead of accelerating downward. These are subtle signals, but they matter more than any prediction you will ever hear, because markets speak through behavior, not through opinions. Now, I am not saying the path will be straight. Markets never move in straight lines. Corrections can still happen. Shocks can still appear. Liquidity conditions can tighten temporarily before easing. That uncertainty is always part of the system. It's part of But what I am telling you, based on years of watching cycles unfold, is that the foundation beneath this market is very different from what it was in previous downturns. The players are larger, the capital pools are deeper, the macro forces are stronger, and when structural supply contraction meets even a modest expansion in liquidity, the results can be explosive, not gradually, but suddenly, and often when the majority least expects it. That is the evidence that is quietly mounting. Not in predictions, not in headlines, but in the underlying mechanics of the system itself. I want you to think about something that almost nobody talks about, something that repeats in every major financial cycle, whether we are talking about stocks, commodities, or Bitcoin. The biggest moves in history almost never happen when people feel confident. They happen when people feel uncertain, cautious, and late. And this is where most investors make the same mistake over and over again across decades. They wait for confirmation. They wait for the news to turn positive. They wait for analysts to raise targets. They wait for the charts to look safe. But markets don't reward comfort. Markets reward positioning before comfort returns. Let me take you back to 2013. Bitcoin had already doubled before the majority even realized the rally had begun. In 2017, the most explosive phase occurred in a matter of months after a long period of sideways movement that convinced people nothing was happening. In 2020 and 2021, the same pattern repeated. The early phase felt slow and uncertain, and then suddenly the acceleration became violent and unstoppable. This is not randomness. This is how reflexive markets behave. Reflexivity is a concept many people hear but few truly understand. It means that price itself changes behavior. Rising prices attract attention. Attention attracts capital. Capital drives prices higher. And that loop feeds on itself until the system reaches saturation. The same process works in reverse during downturns, but during the upward phase, it can create moves that seem irrational to those who are not positioned early. And here's the critical point I want you to understand. The reflexive phase does not begin when everyone believes. It begins when almost nobody believes. Right now, sentiment indicators are still showing hesitation and fear. Many investors are still anchored to the recent correction. They remember the drop from above 120,000. They remember the volatility. And human psychology works in a very predictable way. Recent pain weighs more heavily than future opportunity. This is called recency bias, and it is one of the most powerful forces in financial markets. People expect the future to look like the recent past, even when the structural conditions are changing underneath them. You can see this pattern not just in crypto, but throughout economic history. After the 2008 financial crisis, investors avoided equities for years, even as the market began a historic bull run. After the dot-com crash, technology stocks were ignored long after the fundamentals improved. After every major shock, the majority remains cautious far longer than the cycle requires. And while the majority hesitates, the market quietly builds momentum. I want you to look carefully at what happens when key levels in any market begin to break. At first, nothing dramatic occurs. Then algorithms trigger. Then systematic funds rebalance. Then short positions begin to close. And finally, momentum traders enter. What begins as a small movement becomes a cascade. This is not speculation. This is market mechanics. Liquidity does not enter all at once. It enters in waves, and each wave reinforces the next. That is why rallies often appear slow at first, and then accelerate in a way that seems impossible to stop. By the time the public notices, a large portion of the move has already happened. And this is where the real paradox appears. The moment when the risk feels lowest is often the moment when the upside is already largely behind. And the moment when uncertainty feels highest is often when the foundation of the next major move is already forming. You might feel that contradiction right now. On one hand, the macro environment still feels uncertain. On the other hand, structural signals are improving. This tension creates hesitation, and hesitation delays participation. That delay is exactly what allows the reflexive phase to build without immediate overcrowding. I've watched this pattern unfold many times. Markets do not move because everyone agrees. Markets move because enough capital begins to move in the same direction, while the majority is still undecided. And when that tipping point is reached, price begins to move faster than logic, faster than forecasts, faster than most people are psychologically prepared to accept. You will start to hear phrases like unexpected breakout, surprise rally, stronger than anticipated momentum. But nothing is truly unexpected if you understand the mechanics beneath the surface. What looks sudden to the crowd is often the result of forces that have been building quietly for months. That is why explosive phases feel so shocking. They are not born overnight. They are born in silence, in doubt, in hesitation. And right now, if you step back and look at the behavior of the market, you can see the early ingredients of that process beginning to appear again. Not confirmation, not certainty, but the early mechanics of reflexivity, the early shifts in positioning, the early signs that capital is beginning to move while the majority is still watching from the sidelines. That is how every explosive phase begins. Now, I want you to focus very carefully because this is the part most people misunderstand. Markets are not decided by one event, one headline, or one prediction. They are decided by the interaction of forces, and when those forces begin to align, movements that once seemed impossible suddenly become inevitable. Right now, there are several variables that will decide the direction of this market, and you need to understand them clearly if you want to understand what comes next. The first variable is global liquidity. I want you to think about this like the tide in an ocean. Individual assets are boats, but liquidity is the water itself. When the tide rises, almost everything floats higher. When the tide falls, even strong ships struggle to move forward. Over the past 2 years, central banks around the world tightened financial conditions aggressively to fight inflation. Interest rates rose at the fastest pace in decades. Balance sheets were reduced. Credit conditions tightened. And naturally, risk assets felt that pressure. But now, you are beginning to see something subtle but extremely important. Inflation trends are moderating in several major economies. Bond markets are already pricing future policy shifts. Yield curves, which had been deeply inverted, are starting to change shape in some regions. And historically, when yield curves begin to normalize after inversion, it signals a transition phase in the economic cycle. This does not mean immediate easing everywhere, and it does not mean the path will be smooth, but it does mean the direction of expectations is beginning to change, and expectations are what move markets first. The second variable is institutional behavior. Years ago, Bitcoin was a small, isolated market. Large funds could ignore it completely. That is no longer the case. Today, Bitcoin exists inside portfolios, inside ETFs, inside allocation strategies that are reviewed quarterly and adjusted systematically. And institutions do not react emotionally. They react to models, to correlations, to macro signals. When volatility decreases and correlations stabilize, allocations can increase not because of excitement, but because of risk management frameworks. That kind of capital moves quietly, but when it moves in size. I have seen this in other asset classes before. When gold began entering institutional portfolios in the early 2000s, the move was not explosive at first. It was gradual, persistent, and then suddenly the price entered a powerful multi-year trend. The same dynamic appeared in emerging markets when global funds began allocating capital systematically rather than opportunistically. Structural adoption changes the rhythm of a market. The third variable is risk appetite across the global financial system. When investors feel uncertain about growth, they hold cash and defensive assets. When confidence begins to return, even slightly, capital begins to rotate. And that rotation often starts slowly, almost invisibly, before accelerating. You can already see small signs of this behavior in different corners of the market. Volatility compressing after large drawdowns, capital returning selectively to stronger assets, correlations shifting. These are not dramatic signals, but they are meaningful ones. But I also want you to understand the risks, because every cycle has them. Liquidity conditions could tighten again if inflation surprises to the upside. Geopolitical shocks could disrupt capital flows. Regulatory uncertainty could delay institutional expansion. Markets never move in straight lines, and anyone who tells you otherwise is ignoring history. In 2013, Bitcoin dropped more than 80% before recovering. In 2017, corrections of 30 to 40% happened multiple times during the same bull phase. In 2021, sudden liquidations erased billions in hours. Volatility is not a flaw of this market. It is part of its nature. So the path forward, whatever it becomes, will not be smooth. There will be doubt, corrections, and moments when the narrative shifts again. That is how markets function. But here is the critical point I want you to remember. Bitcoin is no longer an isolated experiment. It is no longer a fringe asset discussed only in small communities. It is now part of the global macro conversation. It reacts to interest rates, to liquidity cycles, to currency movements, to institutional positioning. It has become part of the system it was once separate from. And when an asset becomes part of the global macro system, its major moves are no longer random. They are tied to the same forces that move equities, bonds, commodities, and currencies. That means the next major move in this market, whenever it comes, will not be caused by a single tweet or a single headline. It will be the result of liquidity, psychology, and capital flows converging at the same time. And when those forces converge, movements that once seemed impossible can happen faster than anyone expects. So as you sit here listening to me, watching the charts move hour by hour, remember this: markets rarely give clear signals in advance. They give fragments, contradictions, and subtle shifts. And only when you step back and see the entire structure do those fragments begin to form a picture. Right now, that picture is still forming. The variables are still moving. The tide has not fully turned. But the currents beneath the surface are shifting. And in financial history, it is often the quiet shifts beneath the surface that precede the loudest moves anyone has ever seen.